Thank you, Madam Chairman. I do believe in the issue of small business credit. It's not an issue of more capital. It's an overcorrection on the behalf of the regulators at the banks. I really believe, again, I'm not a banker, not an expert in the area, but especially in commercial real estate, even though they're told these are guidelines, repeatedly these are guidelines, banks know, community and regional banks know if they go over a dime over the concentration thresholds, they're going to enjoy a special visitation from their friendly banking regulator. Plus, the requirement of setting aside cap reserves for commercial real estate that are far in excess of the real risk of that loan is really creating. I can't overstate the problems it's creating among credit-worthy projects, not just inhibiting growth, but I think creating again a much more severe commercial real estate crisis where we already know there are real challenges anyway. I really do appreciate your focus on that area among all the other things you're doing. Critical that the Fed be listening and injecting common sense wherever possible in that process. Can I ask you about two things? One about sort of the trade-off between inflation and unemployment, and also a question about the balance sheet and exit strategy. We've had a couple of people testify before Congress here recently. Professor Lawrence Ball advocated raising the Fed's inflation target to 4%. His argument was that higher inflation would alleviate unemployment and give the Federal Reserve more room to reduce nominal interest rates in the future. Sort of that trade-off again, inflation and unemployment. How do you respond to Professor Ball's argument that unemployment is so dire that we should inflate our way to a more rapid recovery?
Well, his argument is that at a higher inflation rate, then nominal interest rates would also be higher on average, and that would give more space to cut during a recession and perhaps more ability to create impetus. So that's not a logical argument, but it has substantial risks which are the Federal Reserve over a long period of time has established a great deal of credibility in terms of keeping inflation low, around 2%, roughly speaking. And you can see that, for example, in inflation index Treasury debt, which shows that people expect over the next 10 years about 2.2% inflation on average over that 10-year period. If we were to go to 4% and say we're going to 4%, we would risk, I think, losing a lot of that hard-won credibility, because folks would say, well, if we go to 4, why not go to 6? And if you go to 6, why not go to 8? It'd be very difficult to tie down credibly expectations at 4, beyond which, of course, in the longer term, low inflation is good for the economy, and 4% is already getting up there a bit, and would probably have detrimental effects on the functioning of our markets and so on. So I understand the argument, but that's not a direction that we're interested in pursuing. We're going to keep our inflation objectives about where they are. We think about 2% is about appropriate given biases in measurement of inflation, and given the need to have a little bit of space between the average inflation rate and the risk of having deflation or falling prices. So that's where we're going to be. That's the path we're going to be following.
We've raised the issue of expectations, and there are, I believe, in this economic recovery, rational expectations that businesses will see, higher tax rates, higher energy prices, more regulation. I do think that has an impact. And individuals as well, the high debt, someone has to pay that back. Is it going to land on them? I think there are, and does it affect our economy? All part of the psyche and confidence of business and consumers. One of those areas of uncertainty is the extraordinary balance sheet expansion of the Fed. Recently, testifying for the House Financial Services Committee, Professor John Taylor stressed how important it would be for the Fed to provide an exit strategy with explicit decision rules, such as to allay fears of surging future inflation, reassuring Congress that the Fed will not continue to exceed its traditional purview of monetary policy. Are you prepared to lay out a definitive roadmap to normalization?
Yes, to the extent that we we've determined we haven't determined all the details. We're obviously going to see how things evolve. But I have recently testified before the House Financial Services Committee, and also released separately a document, another testimony, which has laid out our proposed exit strategy, and we are developing the tools to do that. This has been an ongoing campaign on my part and on the Fed's part, going back to last summer when I published a Wall Street Journal op-ed that laid out the strategy. And my impression is that early on that there was a lot of concern in the markets about this large balance sheet and the large amount of reserves in the banking system. Now, I'm not saying that the concerns have completely evaporated, but I think that over time that we have provided a lot of information about our exit strategy, and my sense is that it's had a good effect, that for the most part there's a lot of confidence in the financial markets that we do know how to exit effectively, and we will exit effectively, and that we'll do so in a way that doesn't lead to any increase in inflation. And again, one piece of evidence is the long-term break-evens in the inflation-indexed bond market. So we are doing that. I don't think we can give quantitative rules at this moment exactly how to do that, because I don't think we have enough knowledge, but we do know that we have all the tools we need to drain those reserves and to reduce the balance sheet over time, and to raise interest rates when it becomes necessary to do so to avoid inflation.
Great. Thank you, Mr. Chairman.
Thank you.